Okay, let's get started. Today we are going to go over exam 3 from last year. So if you have any questions at any point, just interrupt me. I'm not really great at paying attention to chat, so if you just unmute and interrupt, that'll be a lot better. I think most people know me by now, but I'm Amy. I'm your TA. If you have any questions, even after the review session, please feel free to send me an email and ask. Today we are going to start with section 2. That's where most of the points are on the exam, and I really recommend that you start there because I don't want to see you leave points on the table. It's easy to go through section 1 with the multiple choice questions and just circle things if you run out of time, but it's really hard to just speed through these short answer questions. So let's get started. On January 1st, 2019, Wild Blue Company purchased for $400,000 a new machine that has an estimated useful life of 4 years or 660,000 cutting operations, after which the expected salvage value is $40,000. And so now it's going to ask us to calculate depreciation expense for 2019 and 2020 using these 3 different methods. So straight line is actually pretty easy. For straight line, we're just going to do its cost minus the salvage, which is another word for residual value, divided by the useful life. So it tells us that the cost is $400,000. It has an estimated useful life of 4 years, and the salvage value is $40,000. So we just start plugging in, right? So we get 400,000 minus the 40 divided by the 4 years of useful life is $90,000. And the thing about straight line value is that every single year it's the same amount of depreciation. So this number is never going to change. So this 90,000 is true for 2019, and it's also true for 2020. Are there any questions there? That one's the most basic, easiest one to do. Double declining balance is a little bit different. So for double declining balance, we do care about the salvage value, but we don't care about it until the end. We calculate this. It's the cost minus any accumulated depreciation, and it's that value times 2 because of the double, right? 2 over the useful life. So for 2019, it's 400,000. That was the cost. There's no accumulated depreciation yet because it's the first year, so that's just minus 0, times 2 over the useful life of 4. So 400,000 times 1/2 is just 200,000. So now in 2020, we have our cost of 400,000, but now we do have accumulated depreciation, right? We have this accumulated depreciation from last year. So it's the 400,000 minus the 200,000, and then we multiply that by that same 2 over 4. But this time, 400 minus 200 is 200 times 2 over 4, or 1/2, is 100,000. So in 2019, the accumulated depreciation was 200,000, and in 2020, the accumulated depreciation is now 100,000. Are there any questions about that? All right. So units of production, we need to go back. We do need another value up here from the top. So it tells us also, we're going to need this for units of production, that there are 660,000 cutting operations that this machine is capable of over its lifetime. So for units of production, it starts kind of like the straight line, it's going to be the cost minus the salvage, and then you're going to multiply that value times the units that you produced this year divided by the units it's expected to produce over the lifetime. So for 2019, the cost minus the salvage is 400,000 minus the 4,000, or 40,000 rather. And then you're going to multiply that. It tells us here, it has to tell you how many units you produced, right? So it tells us that in 2019, it's 99,000. So we're going to multiply by 99,000 divided by that 660 that we grabbed from the top. So this is going to be 54,000. And then in 2020, it tells us that there were 96,000 for this year. So it's the same 360,000, the 400,000 minus the 40,000 times, now it's 96,000 over the 660. So now the answer is 52,363.64. So that's how you do those 3 different kinds of depreciation problems. Are there any questions about that? Is there anything I can clear up for you there? We all good?
So can you just explain the units of production again, like what you have to do? I'm a little confused by that one.
Yeah, sure. Okay, so for units of production, you're basically finding out how much per unit, like what the depreciation is per unit. So the cost minus the salvage is like the same as for the straight line. You're figuring out what the machine is kind of like worth. And then, so if you divide by the units per like the lifetime, so for this example, it's 400,000 minus the 40,000 divided by the 660,000. So if you were to do that math, 360,000 divided by the 660,000, you would get that each unit is going to cost you roughly 55 cents if we round. So each unit every time you create a unit, it depreciates your machine by 55 cents basically. So if you make 99,000 units, so if we do this 99,000 times the 55 cents, well, actually, if you were to do it, you'd actually get a different number just because of rounding. But it's telling you that in that year, all those 99,000 units essentially depreciated your machine by $54,000. And then in 2020, you didn't do 99,000 units anymore. You did 96,000 units. So if you were to do that 96,000 times that same 55 cents per unit, you'd actually get a different number again because of rounding, but you would get this 52,000. So the amount of depreciation is different because you created different numbers of units, but it's depreciating your machine based on how much you use the machine as opposed to just how long you've had the machine. So it can be a more accurate method of depreciation because it's based on how many units you actually produced, how much you used the machine, as opposed to just some sort of arbitrary like length of time. Because you might use it a lot. I'm sorry?
Where are you getting the 55 cents from?
The right here. So this 400,000 minus the 40,000 that's 300. Screen is not working great. 360,000. And then if you divide that by the total number of units that you're expected to be able to produce, so the 360,000 divided by the 660,000, you'll get 0.54545454 repeating. So it's roughly 55 cents per unit.
Okay, thanks.
Okay? Any other questions? All right, great. So the next question says, Aluminum Inc. engaged in the following transactions involving its common stock during 2019. So on February 2nd, it issued 10,000 shares of $15 par value common stock at $90 cash per share. Excuse me, on August 1st, it purchased back 3,000 shares of common stock at $93 per share. September 1st, it resold 1,200 of those shares of treasury stock, and then it announced a dividend. And the question asks you to do the journal entries. So I'm going to type these. Okay, so on February 2nd, we issued 10,000 shares of $15 par value common stock at $90 cash. So what happened here, right? Well, we got cash. It tells us we got cash, so we know that cash gets debited. And we are going to calculate this. We sold 10,000 shares and we sold them for $90 a share. So that means we got $900,000. And it tells us, so it told us about the 10,000, it told us about 90. And it also tells us that there's $15 par value. The par value is the legal amount that you can sell it for, right? So that's like the legal minimum amount that the company has to keep on hand for that stock. They're not supposed to sell it for less than that amount. So we're going to keep that amount separate from whatever else they sold it for. So we sold 10,000 shares and that legal par value is $15. So our common stock is going to go on our books for $150,000. So 90,000 and 100 or 900,000 and 150,000, those don't match. They need to, right? So the difference between the 90 and the 75 is going to go to an account that we're going to call APIC, additional paid in capital. And so it's a plug. You could just subtract the 150,000 from the 900,000, or you could subtract the 15 from the 90 and say, okay, well, that's 75. There were 10,000 shares times 75. So that is what goes to the APIC account. And so that's 750,000. So now the 900,000, we can see how that was divided between the common stock and the additional paid in capital. Okay, so August 1st, purchase back 3,000 shares of common stock at $93 cash per share. So there's common stock that's out there, right? And that's our common stock. We can purchase it back. And when we purchase it back, it goes into our, like, I like to think of it as going back into our treasury, like, kind of like a castle, you know? They've got like a treasure room. So we have this treasury stock and we purchased back 3,000 shares at $93 a piece. So now this treasury stock has to stay at $93. Whatever it comes in as, that's how it stays, as long as we're using this particular method. So we bought those 3,000 shares of treasury stock and we paid cash for $279,000. That's all we need to do for that journal entry. But now we had all of those, right? But we sold 1,200 shares for $99 a piece. So we got cash. We sold 1,200 shares for $99 a piece. So we got cash of 118,800. And now, like I just said up above, the treasury stock stays priced at the amount that we purchased it back for. So the treasury stock, we sold back 1,200 shares, but we have to keep it at that 93. If it went in, if it came in at 93, it's coming out at 93. So treasury stock is 111,600, and now 118,800 and 111,600, they don't match, right? So that's a plug, but there's also the difference between 93 and 99 is 6. So 1,200 times 6, that's what's going to go to this APIC treasury stock. It's the gain on the treasury stock, because we bought it back at 93, we sold it for 99, so there was a $7,200 gain, but we don't call it a gain. We just put it in this additional paid-in capital treasury stock account. And then we're going to issue dividends. So the thing about dividends is that you can't, as a company, you can't like issue dividends to yourself, right? That's your money. You can't like give yourself money. That doesn't really make sense, and that's not allowed. So there's shares that are authorized. Those are all the shares of stock that a company is ever allowed to sell. It's not necessarily the number of shares that they have sold, though. So don't let an authorized number confuse you. There's all of the shares that are issued, which are all of the shares that at one point were authorized and have at some point been sold. Those are issued. At some point they were sold. And then there's the stock that's outstanding. So the stock that is issued could have been repurchased as treasury stock, but the stock that's outstanding is held by other stockholders. It's not held by the company. So dividends can only be issued on stock that is issued and outstanding. So we have to figure out how many shares are issued and outstanding in order to do this problem. So it tells us about the 10,000, right? We've still got this 10,000. We repurchased back 3,000. Need like another color here. So there's the 10,000, the 3,000, and then we resold 12,000. So if there were 10,000 shares, we purchased back 3,000. So now there are 3,000 shares that are still issued, but they are no longer outstanding. So we have to take those out. But then when we sold those 1,200 shares, though, they became outstanding once again. So the 10,000 minus the 3,000 plus the 1,200 means that there are now 8,200 shares that are issued and outstanding. So those are the shares that we can issue a dividend on. And it tells us that we issued the dividend for 50 cents a piece. So if we have 8,200 shares that we're issuing 50-cent dividend on, that means that the dividend is for $4,100. So we can call this dividends for $4,100, and we can call this dividends payable for $4,100. Are there any questions about that? Does that all make sense?
How do you know whether to add or subtract? Like when you start at the 10,000 that I get, so like when you purchase back, wouldn't you expect to like add more shares, I guess, to you?
So only if they authorize more shares. So a company might get 100,000 shares over their, like the whole course of their life to issue. So they're authorized 100,000 shares, but they're not necessarily going to issue all 100,000 of those shares all at once, because they might want to save some to issue more later if they need to make more money, or maybe they need to keep some so that they can pay their CEOs with it. There are reasons why they don't issue all the shares, but just because a whole bunch of shares are issued doesn't mean they necessarily even want them all out there. Sometimes they do issue more shares than they probably should have or they want to. There's a lot of reasons. You can rebuy back shares to change the price of the stock. There's a lot of reasons why a company might want to repurchase shares. So they're not issuing more shares. They're not issuing shares that had already been or that weren't already issued. They're trying to take, there's like a marketplace where all their shares are, and they're trying to take them out. They're trying to collect them back, right? So we subtract those 3,000 shares from what's out there issued and outstanding. Does that make sense? Like there's like, it's like there's, you know, you've got inventory that's like out in the world and you're trying to, I guess it doesn't make sense to like collect it back, but you've got shares that are out there, and if you collect them back, you can make them more valuable, right? You can like raise the stock price if there's less shares out there for other people to own, right?
So when you're actually subtracting it, it's like you're subtracting it, I guess, from the total amount that's out there?
Yes.
Okay. So like when you're reselling it back, then you're just adding more to what was out there?
Exactly. You're releasing it back to the wild, you know? Like,
so would it be like the same every single time, like when we purchase back and we resell, whether to add or subtract? Okay.
Yep, you always, if you purchase it back, you subtract it from what is issued. Those 10,000 are issued and outstanding. The number of shares that are issued doesn't actually change. If you buy and sell treasury stock, there are still 10,000 shares that are issued. There are just only 8,200 that are issued and outstanding. There are still 10,000 issued. But we are subtracting those 3,000 shares from what are issued and outstanding, and then we are sending those 1,200 back out to be outstanding. So we're changing the number of shares that are issued and outstanding. We're just not changing the number that are issued.
Wait, so when you issue something and you resell something, they're just adding it, right? That's what you're trying
Well, yeah. So when you issue something and when you resell something, yes, those are additions.
Okay, then purchasing, subtracting. All right, thank you.
Yep. Any other questions? Okay, so this one is a statement of cash flows. And it's just asking you for the indirect method on the cash flows from operating activities. So there's 3 sections to a statement of cash flows, right? There's the cash flows from operating activities, and the cash flows from operating activities are going to be all your current assets and all your current liabilities. All the things that you do to make money in your business, like the normal things that you do, not like extraneous, selling a random machine or whatever. And then there is the cash flows from investing activities, and those are all your long-term assets. So that's when, if you were to sell a random machine, you're not normally selling machines, you're normally selling water bottles, but you sold this machine that you had that you didn't need anymore. That's a long-term asset. That's a cash flow from investing activity. If you had no receivables out there, that's a cash flow from investing activity. You're not normally making loans, but you did, so that is a long-term asset. That is a cash flow from investing activity. And then there's cash flows from financing activities, and those are all your long-term liabilities and all your equity things. So that's if there's a bond or if you issue stock, that's where that stuff goes. Cash flows from financing. It's also where dividends that you pay will go. Dividends that you receive, interest, those things go in cash flows from operating activities. I don't think that they're going to ask you about those things, but dividends that you pay go in the cash flows from financing activities because they are an equity thing. So with the indirect method that they're asking you to use, you need the net income, and then you're going to add back to it things that are not cash, because the statement of cash flows is only asking you about where did your cash go and where did it come from. It's specifically tracking that one account. So for this, we're going to need the net income, which comes off of the income statement. And we also need the depreciation expense, which also comes off the income statement. If there were gains and losses, those things also on the income statement. This question, there aren't any of those. And then the other thing that we have to do, because this is the cash flow from operating activities, we have to track our current assets and our current liabilities, right? Current assets, current liabilities. So it gives us this information down here, and we need to figure out the change in our current assets and the change in our current liabilities. So accounts receivable started the year at 114,000 and it ended the year at 93,000. So that means that there was a decrease of $21,000. Our inventory started the year at 120,000 and it ended the year at 129,000. So our inventory increased by $9,000. Our prepaid expenses began the year at 15,000 and ended the year at 9,000. So that means that those decreased by 6,000. And our accounts payable started the year at 69,000 and ended the year at 66,000. So there was a decrease there of 3,000. So current assets have an inverse relationship in this indirect method, right? So if a current asset increased, we're going to subtract it. And if it decreased, we're going to add it. So the way to think about this, so think about accounts receivable. Accounts receivable is you giving people your inventory, but them not actually giving you money, right? They owe you money, but they didn't give you money. So when our accounts receivable goes down, it started at 114 and it went down to 93. That means that people actually gave us money that they owed, right? So we actually collected money there. And accounts payable and other current liabilities are going to have a more direct relationship. So if it decreases, we're going to subtract it. If it increases, we're going to add it. So if you think about accounts payable began the year at 69,000 and it ended the year at 66,000. That means we paid $3,000 that we had owed before. So that's $3,000 that flowed out, $3,000 that we didn't lose, but we paid. And so our cash went down by 3,000. So we will subtract it, which is kind of the opposite of what happened in the accounts receivable. The accounts receivable went down because we collected money. That was an inflow. So that's why we will add it. So let's go ahead and do the actual problem here, right? Okay, so we have cash flows from operating activities. So we're going to start with net income. And the net income is $591,000. We're going to add back our non-cash depreciation expense because that had originally decreased our net income and it's not cash. So we're going to add that back in. So 135,000. And now we are going to consider our changes in the current assets and the current liabilities. So we see that this was a decrease of the accounts receivable was a decrease. So we're going to add it. So we're going to add our change in accounts receivable of 21,000. This inventory was an increase. Inventory is a current asset. So we are going to subtract it. We're going to subtract our change in inventory. Our prepaid expenses are also an asset, right? So there was a decrease, so we're going to add those back in. So the change in prepaids. And then our accounts payable is a current liability. It decreased, so we are going to subtract that.
Wait, can you explain why the account and prepaid why they decreased, but then you put them as an increase?
Well, so it decreased. So the prepaids are added here. The inventory is decreased. The accounts payable is decreased. Right? So it was a decrease, but we're going to add it. My screen is being wonky today, but it's added, right?
Yeah, I just want to know like why.
Prepaid expenses are our current asset, right? We prepaid our rent, and so we paid it like at the beginning of the year, and so now that's an asset that we get to use up over the course of the next year.
Okay.
It says expenses, but it's a prepaid expense, and so it's a current asset.
And then you're then saying accounts receivable is a current asset. It's not a current asset too.
Accounts receivable is a current asset, yes. So the current assets, all the current assets, so accounts receivable, inventory, prepaid expenses, those things are current assets, and so they have that inverse relationship where they decrease, so we add them, or if they increase, we subtract them. Whereas current liabilities have a positive relationship. So if a current liability decreases, we subtract it. If a current liability increases, we add it.
Okay. So accounts, inventory, prepaid, those are current. So it's like it's inverse.
Yes.
Current. So adding, subtracting means adding. And then for liability, is that what you said?
Liability? Yep. Current liabilities have a negative.
So they're direct then, right? So if it's adding, it means adding.
Yes.
That makes sense. Thank you.
You're welcome. All right. So if we do all this math here, we get to 741,000. All right.
Yep. Financing investing is long-term assets?
Investing is long-term assets, yes.
Okay, that's like equipment, right?
Yes.
Equipment. So how would you classify like if you're receiving like stuff from customers, like from a sale or something?
So stuff from customers, that like money that comes in from customers, is a cash flow from operating stuff. That's customers give us the money that we need to make our operations go, right? So those are operating activities.
Okay.
Those would be like when we got cash from sales, or when we get cash from accounts receivable. But because this is an indirect method, we don't actually, it's kind of backwards, but since it's the indirect method, we don't actually care about the cash that came in from customers, because that money is already included in our net income. We are just adjusting our net income for things that aren't already included, or that are included that shouldn't be included. So the direct method, we would calculate cash flows from customers, cash paid to suppliers, cash paid for, you know what I mean? Like the direct method, we care about where the cash comes from. So the cash that comes in from customers and the cash that goes out to all the people that it goes out to. But the indirect method, we're adjusting net income. So that cash is already included. Net income is sales revenues, right, minus expenses. So the net income already includes all the money that came in from customers and all the money that we paid out, all the expenses. So that's where the difference is. Does that make sense?
Yes, thanks.
Okay. All right. Okay, so now let's do some bonds. Everybody loves bonds, right? So on January 1st, 2016, a company issues, all right, so there's a lot of fun information here. So it issues a 3-year bond with a face value of $200,000. There's a stated interest rate of 8%. It tells us that they received $194,000 for the bond. And the other important thing that it tells us is that the interest is paid semi-annually, which means twice a year. So the first thing it tells us is to prepare the journal entry for the issue of the bond. So this is fine. So on 1/1/16, so it tells us when we issue a bond because we need money. We're trying to do something. We need cash to do it. So that's why we issue a bond. So when we sell a bond, we get cash. And it tells us exactly how much cash we got. It tells us that we got $194,000 for the bonds. And we know that we issued a bond payable for $200,000, right? Because that was the face value of the bond. So 194, 200,000, these things don't match, right? We need them to match. So we can see that we need more on the debit side, right? So we are going to debit the discount when you first issue it. This is just something you got to remember, but debit the discount, the D's, just when you first issue it though. So the discount, yep.
How do you know the difference between like a discount and like a premium thing? Because that's what I've had trouble with, just finding like which one to do.
Okay, so you know that your bond payable, why does this go away? I don't want this to go away. So you know that your bond payable is for $200,000, right? If it tells you that you received 194, you got less for it than you should have. The thing is worth $200,000, but because it says that because the market rate is higher than the stated interest rate, so you're offering 8% interest on your bond. So you're out there in the marketplace. You're like, look, I've got this bond. I'm going to pay 8% interest. But the thing is, like Joe Schmo next door is like, oh, look, I've got this bond and I'm going to pay 10% interest. And so somebody's like, well, why would I buy your bond if I can buy his bond and get more interest? So in order to entice him to buy your bond instead of the other bond that's going to pay him more, you have to say, well, look, I can sell mine for less. So you're getting a discount, like when you go shopping and you get a discount, you pay less, right? I'm going to sell it to you for less. So you're going to give me less money, but I'm still going to give you this amount of interest. So if you're getting less money than your face value, it's a discount. If you were to get more money, if it said you received $204,000 instead of $200,000, that would be a premium. So if you're out there and you've got this bond and you're like, look, I'm going to give everybody 8%, and Joe Schmo next to you is only giving out 6%, then people will kind of, it's like in a housing market when there's a house and people like bid it up, like everybody's kind of fighting over it. They're like, well, I'll give you 200,000, I'll give you 204,000, I'll give you, so they are paying more for the right to get more interest. And so that would be a premium. You would pay a premium on it for the right to receive more money later. So if you get more money, it's a premium. If you get less money, it's a discount.
Well, if your bond is greater than your cash, right? Can you like say it like that?
I'm sorry?
If your bond's payable is like your cash, then it'd be a discount, right?
Right. If your bonds payable was bigger than your cash, it's a discount.
And then versus premium. Okay, thank you so much.
You're welcome.
I have a quick question.
Yep.
Just for your date of the transaction, you have it as January 1st. You mean 31st?
No, so this is just the issue. It says on January 1st, the company issued. So prepare. Oh, well, all right. Yeah. There's a discrepancy there, but sure, we can put it at the 31st. I think they probably meant the first, but sure.
Okay.
Okay, so now prepare the journal entry to record the first interest payment on June 30th. Okay, so now we have to figure out the interest. So we know that there's this, the coupon rate was 8%. We know that. And the face value is 200,000. So even though we paid less and we got it at a discount, the interest is always calculated on the face value, which is the 200,000 times that coupon rate that they said, that interest rate. So that's 8%. So 200,000 times 8% is 16,000. And it told us that the bond issues interest semi-annually, which means twice a year. So because it's twice a year, this interest is for the whole year. So we only want half of this because we're going to issue them half now and we'll issue the other half later. So that's 8,000. So the thing about interest on a bond is that the cash paid is always just going to be this $8,000. This cash paid isn't ever going to change, but we do have that discount in there. And in your examples here, we have to amortize the discount. We're going to do it straight line. So we know that the discount was this 6,000.
Wait, why is it 2 again?
Why is it what?
2? 60?
2? Because it's semi-annual.
Oh, okay.
Right?
Yeah.
So it's the 6,000 and it's a 3-year bond. It told us that up at the top. So that's $2,000. So every year we're going to amortize this discount by $2,000. So we kind of took a loss on the bond, and we're not going to call it a loss. We're calling it a discount. But we still have to make this bond's net value on our books. We have to get it back to the 200,000 so that when we pay it off, it is worth 200,000. So every year we're going to call the interest expense a little bit more than it actually is. So it's the 2,000 divided by 2 because it's semi-annual. So every 6 months we're going to say that the interest expense was actually $1,000 more than it was, so that by the end of the 3 years, that net book value on the bond is the $200,000. So we know that the cash is always going to be the same. We're always going to pay cash out of 8,000. And the discount on the bond payable, we're going to write that down by $1,000 every 6 months. So the interest expense is actually a plug. So the interest expense is the 8,000 plus the 1,000. So it's $9,000. If you had a premium and you amortize the premium, then the interest expense would actually be less because you had a gain. And so you're kind of applying that gain every year towards your interest expense to make the gain kind of, go away so that your net book value is still $200,000. But with the discount, we have to add to the interest expense to account for the loss. So does this make sense?
So why do you make discount bonds payable a credit instead of a debit?
So at the beginning, we have this discount account, right? And at the beginning of the life of the bond, we debited it by 6,000, and we need to make this go away. So every 6 months, we are going to credit it by $1,000 so that by the end of it, it zeroes out. By the end of 3 years, it zeroes out. But we're going to do that by crediting $1,000 every 6 months because we debited it to begin with.
Okay. And so why is the 8,000 cash instead of the interest expense?
So the cash is the amount we always have to pay every single time we pay interest, it's a legal obligation. We have to pay 200,000 times 8%. We have to pay the face value times the amount of interest that we told everybody that we were going to pay. So that's the amount of cash. But like I said, we kind of took a loss on this bond, right? So we have this bond payable that's on our books for 200,000, but the net book value of this bond is the 200,000 minus the 6,000. This bond is only worth 194,000, but when we pay it off, it needs to be worth 6,000. So by decreasing the discount, so right now it's 200,000 minus 600,000, but after 6 months, it'll be 200,000 minus 500,000. So it'll be 194,000. And then after a year, it'll be 200,000 minus 4,000. So it'll be 96. And so eventually that net book value will creep back up to 200,000 after we've amortized all of the discount. Does that make sense?
Well, like I was following you until like the end. So like, how do you like know it's going up, or like, so why do you call it like, I get that you have to like make it back to the original, I guess what it's worth, the face value, but how do you determine by how much? Is it always just by how much it was divided by the years?
Yep, so it's straight line. So it's just like how straight line depreciation is the same amount of depreciation every single year. We took that amount and we divided by the number of years, and so every year it was just hitting a set amount. So it's the same thing for this. It was a $6,000 discount. There are 3 years, $2,000 a year. It's a semi-annual thing, so divide that by 2, you get 1,000. So every single time we pay interest, we're going to hit that discount account for $1,000 to get that net book value back to 200,000. So we're going to just keep whittling away at this account until it finally zeroes out. So
why are you like raising, like calling it, like why are you adding $1,000? Because are they paying in total 9,000 for the interest every single time?
So you don't pay 9,000, you pay 8,000, but on your books, on your balance, or on your balance sheet, your bond is evening out, and your interest expense. Remember, with the statement of cash flows, there were things that were non-cash expenses. The interest expense is part of that. Interest expense is going to be a non-cash expense. On the statement of cash flows, you would add back any bond amortization. You're not going to do that in intro, but if you were to do a more advanced one, that might be on there. You would have to add that back in. Part of that is a non-cash expense. So there's the cash part that they paid, the 8,000, and then there's this extra $1,000, which is like a non-cash expense. It's going to be expensed on the income statement, just as like a loss would be, but it's not really a cash loss. It's a non-cash sort of thing. So the interest expense looks like it's higher than they're actually paying out in cash. Okay,
so it's not cash. That's really the main point. Okay.
Yeah, it's part that $8,000 part is cash, but the rest of it's not actually cash. It's just kind of accounting to make things work out in the end.
Okay.
Wait, I think this is probably a dumb question, but you did 6,000 divided by 3 because it's a 3-year bond, right?
Yes.
And then you did 2 because you're going down the years, and then 1, then that'd be 1,000.
Right. I divided by 2 because it was semi-annual. You could have done 6,000 divided by 6 because while there are 3 years, there are 6 periods. So you could have taken the 6,000 and divided it by 6 periods to get 1,000. That would also work. but I didn't do it that way. I said 6,000 divided by 3 because there were 3 years, and then divided by 2 because each year there are 2 payments in each year because it's semi-annual.
Okay, that makes a lot more sense. Thank you.
Okay. So anything else I can clear up? Happy to do it. Just got to speak up. Good? Okay. And then the last thing I kind of wanted to point out, the exam doesn't ask you to do this, but if they did, if they asked you to, go away, if they asked you to like pay off the bond at the end of the 3 years, then you would just debit the bond payable for the full 200,000, not the cash amount that you got before, but for the full bond payable amount of 200,000, and then you would have to pay cash for the full 200,000. Okay, it's the last thing I wanted to go over on that bond question. So as long as all that makes sense, I will go back to the top and hit up the multiple choice questions. All right, so this is super annoying. Okay. All right, so I like yellow. All right, so the initial recorded cost of a plant asset should include both the cash and or cash equivalent given up to acquire the asset and any cost of preparation for use, true or false. So the answer to this one is true. When you put an asset on your books, it's the cash that you pay for the asset plus, any installation costs or shipping costs, things like that. Anything to prepare it for use. Any repairs or something that comes after that does not get included. They're like routine repairs, things that happen after you put it into use, then those don't get included. All right. The Salt Company purchased a tractor at a cost of $120,000 on January 1st. The tractor has an estimated salvage of $20,000 and an estimated life of 8 years. If Saul uses the straight line method, what is the book value January 1st, 2023? Okay. So straight line method. So we know that this is going to be 120. I'm going to drop the zeros, okay? So it's 120 minus 20. And that's where those numbers came from. And then 8 years. So every single year, you're going to depreciate this by $12,500. Now, this starts at January 1st, 2019, and it's asking you about 2023. So you got all 2019, all 2020, 21, 22, but we're going to January 2023, so we're not including that one. So you got 4 years of depreciation that you have to account for. So this times 4 is 50. So there's $50,000 of depreciation on this machine at the end of 4 years. So the machine has a cost of $120,000, has a depreciation of 50. So the net book value at the end of those 4 years is $70,000. So the answer here is letter A. Are there any questions about how I did that? Does that make sense? All right, so how is the gain or loss on a plant asset sale calculated? So when you make a sale, you take the selling price, so the sale price, and you subtract away the net book value, what it's on your books for. So that's the cost minus the accumulated depreciation. And then that will give you the gain or the loss. So the answer to this one is asset sale price minus book value of the asset, letter C.
I have a quick question on 2. So once you find out like how many years of depreciation, like you got the 50,000, you just subtract that from the face value or
Yep.
value?
So this 120 is the cost, and bottom of my screen doesn't work. And this 50,000 is the accumulated depreciation. So the cost minus the accumulated depreciation is the book value that it's on your books at. That's kind of what the amount of money that you have into it at the time, because you paid 120,000, but you've depreciated, so you've kind of recouped some of that cost a little. You might want to think about it that way. So it's on your books now at $70,000.
Okay, and can you just explain like how you got 3?
Right. So the sale price. So when you sell something, if you were going to sell something, you would say you sold something for $100, right? Say you've got say you've got a computer that you've had for a while, right? And say you sell it for $100, and you've had it for a long time, and you might have purchased it for, $600, but you've had it for 5 years. And so really it's kind of only worth like $90 now, right? So the sale price minus kind of what it's worth, like that $90, will give you a $10 gain. Like you kind of made $10 on it. So the sale price is what you got for it. The book value is kind of what it's like worth to you, not necessarily the fair market value, just kind of like what this whole concept of here of net book value, like what it's like on your books at. And then the gain, if you sell it for more than what it's worth to you, you get a gain. And if you sell it for less than what it's worth to you, then you have a loss. But it's the sale price minus the net book value. So if the sale price was 10 and it was only worth 8, you would have a $2 gain. But if the sale price was 10 and it was worth 12, you would have a $2 loss.
Okay.
Does that make sense?
Yeah.
Okay, so franchises are considered to be an identifiable intangible asset and may be definite or indefinite. The answer to this one is true. You might have if you got a franchise, right, you can identify that, but sometimes they're for 50 years and sometimes they're just for however long you want to keep it. So they can have a definite or an indefinite life. Number 5, at January 1st, 2019, Bacchus Company had total assets of $5.4 million, and at December 31st, its total assets were $6.6 million. Their net sales, were $13.65 million, and its 2019 net income was $360,000. It wants the asset to turnover ratio. So the asset turnover ratio, so anytime you see turnover, you know that whatever you're turning over goes on the bottom, and it's going to be the average of whatever it is. So it's the average assets, and then assets would go with sales. So it's either going to be something, the numerator is either going to be sales or cost of goods sold. But with assets, it's going to be sales. So sales is $13,650, and then average assets, so it tells you what these numbers are, right? It's the 660 and the 5.4. So if we add the 400 plus the 600, I'm dropping zeros just because my computer. So if we do that, we get this 13,650 divided by 6 million. So the answer here is 2.275. So the answer is D. Are there any questions about how I did that one? Good on that. Okay. So which of the following does not affect the current liabilities section of the balance sheet? So current liabilities are, all right, well, so purchase of inventory on credit. So of inventory on credit means that we are going to have an accounts payable. Is that a current liability? Yes, that is a current liability. So that will affect the current liability section. Wages owed to employees but not yet paid, that's going to mean that our salaries and wages payable is going to go up because we haven't paid it yet. So that is also a current liability. Insurance bill to be paid next month. All right, well, that means that we have an insurance payable, which is also a current liability. But sale of goods on credit, well, so this time on credit means because we sold goods that we have an accounts receivable. Accounts receivable is a current asset, and so that one will not affect our current liability. So the answer here is D. Number 7. Gold Inc. issued a 60-day note in the amount of $540,000 on November 1st with an annual rate of 6%. What amount of interest has accrued? So it's a 60-day note for $540,000 with an annual rate of 6%. So what that means is we need to figure out what the interest is, because interest is constantly accruing whether or not you're recording it, whether you're like actually recording it or not, right? So it wants to know what interest has accrued. So the answer is going to be $540,000. That's the amount that the note is worth is $540,000, and the interest per year is 6%. So the whole amount of interest that you would pay if this were to go over the course of a whole year would be $32,400. But it's a 60-day note. We still have to notice we still calculated this for a whole year, even though it's only a 60-day note. But at the end of December 31st, that's the whole 60 days. But even if it wasn't the whole 60 days, it would still be times 2 over 12, because it's an annual rate of 12% and 60 days is 2 months. So the answer is 5,400. So the answer is C, 5,400. Are there any questions about that? Interest is always an annual rate. So you will always divide it by 12 and always just multiply it by the number of months that you need. So if it's a 12-month note and you are accruing it for 2 months, it's times 2 over 12. If it's a 2-month note and you're accruing all the interest that you owe, you still multiply it by 2 over 12.
So that 2 is just for the length of the note?
Right. It is for the length of the note. It is also, if it was a 12-month note, though, it would, because it's November 1st, and now we want to know how much has accrued on December 31st, that's 2 months.
Okay, thanks.
So it works for either situation, is my point. All right, so which of the following is not a contingent liability? So a contingent liability is a liability that kind of depends on something else, right? So a lawsuit kind of depends on whether or not you actually win the lawsuit. You can be pretty sure you're going to lose, but you might not. Credit guarantees will depend on whether or not, like, you're guaranteeing something, but it depends on whether somebody else follows through on what they're supposed to do. Environmental cleanup costs, like, you can be like, yeah, this should cost this amount, but Yep.
One question. On the answer key, it said 7 was D. I don't know.
On the answer key for which?
I think for number 7, I think it said it was D.
Yeah, there was a lot of them that were like different,
Yeah.
like answers.
Yeah, so the answer key that I had, I don't know, I took it off of Dr. Burt's Canvas page, and then I didn't pay any attention to it until this morning. And then when I went to look at it, I was like, oh, this is not right. But then when I went back to look and see, he had uploaded a new one. So there was an incorrect answer key. I don't think it's so much an incorrect answer key as he sometimes changes his exams a little bit because his, the other classes are on Tuesday, Thursday, his are Monday, Wednesday, Friday. So he sometimes shortens them a little bit so that they can be done in the proper amount of time. And so I think he had an answer key that didn't match up with the exam that he gave me. So he there's a updated answer key. I can, if you don't have Dr. Burke, I can send that to you afterwards.
Okay, thank you.
Yep.
Which one did you explain after the lawsuits? I just didn't hear what you said.
The environmental cleanup costs. You can, there's like a contingent, the environmental cleanup costs are also, they're going to depend on a lot of other things, like how much you have to clean up and stuff. So the only thing here that's not a contingent liability is a discount on a notes payable. Even if you don't know what that is, a discount on a notes payable sounds like a pretty certain thing. It's not going to depend on other things. So those other things are contingent liabilities. They're going to depend on something else. They're going to depend on somebody else doing something, whether or not that thing actually happens.
So what would the credit guarantees like depend on?
So like a guarantee is like somebody else might, it's like it's like kind of like, you can kind of think about it as like a cosigner on like a loan or something. You might like take out a loan for your student loans, but you got your parents co-sign on it for you saying, okay, if she doesn't pay it off, I will. So it's like a credit guarantee. If they don't give you credit, I will, but it depends on whether or not that other person actually like issues the credit or not.
Okay.
All right, so which of the following is not a payroll tax on wages or salaries? So FICA tax, that's like the Social Security and Medicare tax, that's a payroll tax. The federal unemployment tax, unemployment, even if you don't know what that is, unemployment sounds like a payroll thing, right? State unemployment tax is the same way, but a federal product excise tax, like you don't even have to know what that is, you know that that's probably not a payroll tax, right? Product excise tax. It doesn't sound like it goes with payroll. Which one of the following selections is not a component of paid-in capital? Okay, so paid-in capital is capital that other people pay in to your company. So retained earnings is earnings, right? Your net income that you keep that you don't give out as a dividend. But common stock is stuff that people buy from you. They give you money for it. They pay into your company by buying common stock. An additional paid in capital is the price that they pay above the par value, right? So it's additional paid in capital. So additional paid in capital and common stock are both going to be components of paid in capital, but retained earnings is not something that somebody else pays in. Those are your earnings that you retained, right? So those are not paid in capital. They're all equity accounts, but there's a difference between retained earnings and paid in capital, and retained earnings is not a paid in capital account. Does that make sense? Okay. During May 2019, Bryant Outdoor Corporation announced a 4-for-1 stock split. This brought the number of shares outstanding from 14,681,000 shares to how many? And it's $5.40 par value to something else per share, right? So if it's a 4-for-1 stock split, that means that there are 14,681,000 shares, and you are taking all 14.681 million of those shares, and you're making every single one of them worth 4 more shares, right? So you multiply that by 4. If it was a 2-for-1 stock split, you would multiply by 2. 3-for-1, you would multiply by 3. So this will get you a ridiculous number of shares, 58,724,000 shares. But people aren't actually like paying in, right, to like buy all those shares. You're just giving them. So what you're doing actually is you're taking the $5.40 par value and you're dividing it by 4. So you're going to get $1.35. So the accounts, the common stock and the par value, though the par value changes, but your common stock account doesn't change. It's just multiplying the number of shares, dividing the par value so that your accounts don't change, but the number of shares that you have out there does change. So the answer here is letter D. It's just fancy accounting to like make shareholders, I don't know, happy, I guess. Are there any questions? Okay. Number 12, which of the following rights do common stockholders typically not have? So the right to vote, that's like the big thing that common stockholders get. They get the right to vote and the right to elect the board of directors. So that's a right that they do have. The right to receive the final distribution of assets in liquidation after prior claims have been settled. They do have that right. It's actually, I mean, a lot of times they don't really get that much. A lot of times everybody else takes everything before them. All the creditors get their share, and then if there's anything left, the preferred stockholders get their share, and then common stockholders can take their share. The right to participate in additional issues of stock, that's also a thing that they get. But the right to receive dividends at a predetermined rate, no. So this predetermined rate, that's something that preferred stockholders get, right? That it's like that 7%, they get 7% of the par value, but common stockholders, they just kind of get whatever they get, right? So the answer to this one is letter D. And we're actually going to talk about that a little bit more in depth right now. Okay, so Belmont Inc. has outstanding 10,000 shares of 200 par value, 7% non-participating cumulative preferred stock, and 10,000 shares of $40 par value common stock. If the dividend on preferred stock is 1 year in arrears, and the total cash dividend declared this year is 288,000, then the total amounts distributed to preferred and common stockholders respectively are. Okay, so actually I want to highlight a few things here. So if, where's my thing? Okay, so if there's 10,000 shares, 200 par value, 7%, don't worry about the non-participating, but the cumulative is important. That's the preferred stock, and it says that the preferred stock is 1 year in arrears. So we need to know how much, because we have to pay the preferred stockholders a certain amount of money. That's that whole predetermined rate thing that we were just talking about. So we know that there are 10,000 shares. It's 200 par value. So that's this there's $2 million in your preferred stockholders account, and you're going to pay them 7%. So you're going to pay your preferred stockholders $140,000, and it tells you that those are 1 year in arrears. So that means that you have to pay them back for those year in arrears, and then you need to pay them for this year too. So we're going to multiply that by 2 because it's 2 years that we need to account for. So that's 280,000 that we need to account for. So if we know that we are issuing 288,000 in dividends, and we need to pay the preferred stockholders 280,000 of that 288,000. The common stockholders get 8,000. Preferred stockholders get this 280,000. It doesn't matter that there's 100,000 shares of $40 par value common stock. The common stockholders don't get a predetermined rate. They get their dividends after the preferred stockholders. The preferred stockholders are preferred for a reason. So the answer here is 280,000 to the preferred stockholders, because it says respectively up here, and then 8,000 to the common stockholders. Are there questions about that?
Wait, so you did 140,000 times 2, right?
Yep.
So where did you get the 2 from again?
Yeah, that's my question too.
So it says that the preferred stock is it's 1 year in arrears, which means that, so for preferred stock, you don't have to issue dividends. They're not making you issue dividends, but when you do issue dividends, this is how much you owe the preferred stockholders first. You're saying it's 7% cumulative, which means that any time that they don't issue dividends, you are still owed those dividends regardless of whether they pay them or not. So once they do get around to finally paying dividends, you get paid your dividends in arrears first. So because they're 1 year in arrears, you have to pay last year's dividends. And then because they're preferred stock, you have to pay them before you pay your common stockholders. So you have to pay them this year's dividends too. If they were only paying 280,000 in dividends, then the common stockholders wouldn't get anything, because they would need to pay that dividend in arrears from last year and the dividends that they owe from this year. If they were only paying $250,000 in dividends, they would pay them the dividends in arrears from last year, and then they would pay them the rest of the dividends that they were paying from this year, and they would still owe them. They would be $30,000 dividends in arrears the next time they paid dividends.
Wait, so the arrear is basically last year and then this year. That's an arrear? Is that
That's an arrear is like something that you owe from before. So if it's in arrears, it means that it's like payable.
So if it's at like 2 years in arrears or whatever, it would basically mean like you would have to account for the 3 years, like multiply by 3, because they're 2 years behind, and then you have to account for this year's.
Yep. So if it was 2 years in arrears, you would multiply by 3, and you would not have enough to pay them, right? But if it was if however many dividend years in arrears, you pay for those years in arrears first, and then you have to pay for this year. So it's 2 because it's 1 year's in arrears and then 1 year for this year.
And the 3 years in arrears for them. Right?
Yes. Yes.
Okay, that makes sense. Thank you.
Yep. Okay, which of the following is a cash equivalent for purposes of preparing a statement of cash flows? So a cash equivalent for purposes of preparing a statement of cash flows. So accounts receivable isn't a cash equivalent. Investment in subsidiary company common stock is also not a cash equivalent, and neither is an inventory. A cash equivalent is any like short-term, highly liquid investment purchased within 3 months of maturity. So an investment in a money market fund, that's a very liquid investment. It's very close to cash. So accounts receivable isn't something that's, I mean, you would hope that it is close to cash, but it's not a cash equivalent. The other ones are definitely not going to be even close.
So what is like a cash equivalent? Like,
so what is a cash equivalent? Is that what you asked?
Yeah.
It's like a short-term, highly liquid investment. So it means it's very, like if you were to sell that, it would be very, it'd be very easy to sell and it wouldn't like lose value. So like a 3-month like if you have like a 3-month treasury bond, like because it's within 3 months, that would be a cash equivalent. If it was like a 12-month treasury bill, or am I confusing the two, bills and bonds? But if it was like a 12-month one, there's like time value of money to consider. The interest rates could change, it could lose value. So that's not a cash equivalent. It's not like very close to cash. It's something that is going to be, you could almost call it cash. You know, you've got
Okay.
money in like a money market fund.
What is a money market fund?
It's like a, it's like a, it's not a savings account, but it's kind of like a savings account because they like invest it, and so you can get like a higher interest rate, but you can like take your money out pretty quickly. It's like a investing thing.
Okay.
Cash paid as dividends to stockholders is classified as a cash flow from investing activities in a statement of cash flows. So cash paid as dividends is an equity thing. Equity is part of the cash flows from financing activities. Cash flow from investing activities are your long-term assets, right? So the answer to this one is false because it would be a cash flow from financing activities. A firm's net cash flow from operating activities includes, okay, so we will go over this just one more time because it's always worth it. So cash flows from operating activities are your current assets and your current liabilities. Cash flow from investing are your long-term assets, and cash flows from financing are your long-term liabilities and equity. So a firm's net cash flow from operating activities, cash received from the sale of equipment. Sale of equipment is a long-term asset, so that's an investing activity. Cash received from the issuance of common stock, that's equity, so that's a financing activity. Cash received from the sale of merchandise, well, that's something that you do in your operations, right? So that is a cash flow from operating activities. So that's going to be the right answer. But cash received as a payment of a loan from a borrower, so that is a note receivable. That's going to be a long-term asset, which is a cash flow from investing activities. So like I just said, this C is the right answer because that's operating. Questions? And then if we just go through this one more time. So a cash received, so we want to know cash flow from investing activities. So if we start at the bottom here, cash paid to retire bonds payable. Bonds payable are long-term liabilities, so that's a cash flows from financing activities. Cash received from rendering of services to customers, that's something that we do every day, so that's a cash flows from operating activities. Cash paid as dividends, that's equity, so that's a cash flows from financing. And cash received from the sale of a plant asset, that's a long-term asset, so that is a cash flow from investing activity. So the answer here is A. The excess of sales price of treasury stock over its cost should be credited to, so if we think about this, say we have treasury stock and we originally paid $5 for it, right? And then we turn around and we sell it for $7 a share. So say we get cash, say there was 1,000 shares, right? That we sold for $7 a share. So we get $7,000 cash. But treasury stock only comes in and out at the amount that we paid for it. So it's still on our books at $5,000 per share. It's going to come out of our books at $5,000 per share. we've got 7,000, we've got 5,000. They don't match. The gain in treasury stock goes to APIC treasury stock of 2,000. So we are crediting this paid in capital from treasury stock. So the answer is B. Does that make sense? I think that's the end. Yes, it is. We already did the rest of that.
So when you were doing like the 5,000 and the 7,000, so the 7,000 is which, like the $7 was which number, like the starting or?
That's what you sold it for. So if we have treasury stock, whoops, change my pen. So if we have treasury stock that we purchased for $5 per share, right? So say we purchased treasury stock, say we purchased 2,000 shares at $5 per share. So that would mean that our treasury stock is on our books at $10,000. And then say we sold 1,000 shares for $7. Well, it still has to come out of our books at this original $5 per share. So it's going to come out of our books at 5,000, but we got $7,000 for it. So that's where the extra $2 comes from. In the
so the 5,000 was the actual cost.
Yes, the 5,000 is the actual cost.
Okay.
That's what it's going to come out of our treasury stock at. So there's still like 5,000 in here. It's got to come in and out at the $5 that we paid for it. If there's any extra, any gain, that goes to the APIC. If there was a loss, say we sold it for $3, say we sold $1,000 for $3, then we wouldn't have this like gain account. It would actually come out of retained earnings, actually. But what it wants you to know is that it's not called a gain. It's this paid in capital from treasury stock.
So if you had a loss, it would come out of retained earnings?
Yeah. Unless you happen to have, it's a little more complicated. If we sold this one at APIC treasury stock at this $7, and then there was these 5,000 shares that we sold at $3, for example, then the loss would come out of this account first before coming out of retained earnings. But that's getting more complicated than I think you need to know.
So it's almost like it basically took what it had before to help diminish it?
Yeah.
Okay.
It's like a cushion.
Okay.
Are there any other questions about anything that I can answer for you? Well, anything like on this exam? Are we all good?
If needed, are you still holding office hours tomorrow?
I'm still having office hours, yes. I've got office hours tomorrow and Tuesday, but I don't believe I was going to have office hours on Wednesday. I think by then everything that you guys have due is due. But if you need me, let me know, for sure.
Okay.
Okay?
Thank you.
You're welcome. All right, so I think that's everything. And good luck studying. Like I said, if you need me, send me an email or stop into office hours. I'm happy to help. Have a good weekend.
Have a good one.
Yep.
And you have a good weekend.
You too.